Great, let's begin. I'm Rashawn, PhillipCapital's media host and presenter, and I will be your host for today. Today's session is on the Malaysia market, and you may take a look at the agenda stated here. For this session, we have Kim Cho, investment specialist from PhillipCapital Malaysia, to share the Asia and Malaysia market outlook, and our analyst, Thong will cover the stock picks for the property and construction sectors. Mr. Kim won't be with us to present today, but he has prepared a video presentation beforehand where he shares his insight. So without further ado, let's welcome the speakers and begin the webinar.
Thank you so much for dialing in our session today. My name is Kim, investment specialist from PhillipCapital Malaysia. If we were to move to next slide, we see Nasdaq was actually the best performer year to date, up 31.7% as of end June. And this marked its best first half since 1983. MSCI Asia Pacific ex Japan was a laggard, close around, I think, positive 1.8% year to date, underperforming most of the developed markets. S&P 500 up around 15.9%. Euro continue to trend higher after profit taking in May, up around 16% year to date. Within Asia Pacific, Japan, Taiwan, and Korea were very strong in the first half, up around 27%, 19%, and 14% respectively, driven by the frenzy trends within the AI and tech names. We see some spillover from the US market to the Asia Pacific market as well. Meanwhile, Hong Kong, China regained some strength in June, but still negative year to date. Back home, Malaysia was down 0.8% in June and close to around negative 8% year to date. We were just slightly behind Thailand, which was down around 9.9%. Next slide. As I mentioned just now, Malaysia was down around 0.8% in June and 7.9% year to date. And this is mainly because of the poor sentiment in the banking sector in the first quarter. And moving to the result season in May, we see weak corporate earnings. And also this has led to persistent foreign selling. And to note, it has already been the 6 consecutive months of decline of KLCI. Meanwhile, we see small cap index and the mid 70 index remain fairly strong compared to KLCI, only down by negative 0.5% year to date and up 2.8% year to date respectively. In terms of the sector, we see top performers were utilities, property and construction, as well as transport. And the worst performers are actually finance, mainly led by the banks, industrial, consumers, as well as plantation. We see tech regain some strength in June, recouping some losses recorded in May, and now only down by negative 4.1% year to date. Next slide, we see actually after years of persistent selling by the foreign investors, if not mistaken, it's around 50 billion ringgit since 2018. We see foreign investors actually return to Malaysian market in 2022, net buying around 4.4 billion of Malaysia equities. However, foreign investors continue to sell Malaysia equities in 2023 with cumulative outflows of around 4.2 billion year to date. And as a result, we see our foreign shareholding level at 19.9%, which is a historical low level. Year to date, we see foreigners were buying transport and logistics as well as construction sector, while financial services, industrial and consumer saw heavy outflows. If we were to move to the next slide, right, in terms of the currency performance against dollar, we see regional currencies traded mixed against the dollar for the first half. British pound, Indonesian rupiah, as well as Europe were the performing currencies, while the Chinese yuan, ringgit, as well as Japanese yen were the laggards. Local front, we see Malaysia ringgit continue its downward momentum, weakened by around 5.6% year to date. And if not mistaken, in 2022, we were already weakened against USD by around 5.8%. Let's see if our ringgit performance, whether it's better against other regional. If we were to move to the next slides, last year, beside dollar, local note has actually outperformed most of the peers in the region, except Singapore dollar as well as Thai baht. But unfortunately, year to date, Ringgit Malaysia actually weakened against almost all regional currencies that we track, but our local note still appreciate against Japanese yen year to date. Economists are estimating that Ringgit is actually 18% undervalued. We think that will actually attract more foreign fund flows coming into Malaysia in both equities as well as bonds. Foreign investors tend to invest in countries in which the currencies are relatively undervalued. Right, next slide. Beginning of the year, investors were clouded by issues such as bank failure. But we have to draw your attention that US bank failure is actually not something new, and we have already seen that in the past. And year to date in 2023, there are already 3 banks collapsed, but the amount is actually higher than the global financial crisis level. In terms of total asset, the total collapse is around 548.5 billion of dollar, and you have not shown what that amount represents is actually 1.5 times of Malaysia's 2021 GDP. Of course, we'll continue to monitor the spillover effect, and we think there could be more banks to fail based on history. But whenever there are any bank failures, it's actually another consolation. And we think whenever there's any consolation, it's actually good for the US banks as well as financial system, because they will actually grow stronger and stronger post-consolidation. Next slide. Debt ceiling is not something new, and it's not something that we need to worry at least until January 2025. And to recall, actually the debt ceiling was actually raised by nearly 80 times since 1960, and it's not something new, and it's just a recurring practice for the US government to actually adjust the limit on the amount of the debt that the US government can incur. So it shouldn't be a concern right now. Next slide. If we were to look at the inflation numbers, right? Inflation has actually eased to 4% based on the latest headline CPI numbers, but it's still far away from the 2% target inflation. And if we were to look at the Fed's preferred inflation gauge, the PC inflation is actually on a decreasing trend. And the recent reading is only, if not mistaken, up 3.8% year over year, and the core PC inflation is only up by 4.6% year over year. But it's still very long way to be back to Fed's 2% target. We have to continue monitor the inflation numbers, of course. The June CPI data will actually be released on 13 July. At the time of presentation, market is actually expecting the headline CPI to dip around 3.6% year over year. And given the still elevated inflation, and given the inflation levels have not returned to Fed's 2% target, we think interest rates are likely to stay higher for longer. Next slide. Yes, the Fed actually paused its hiking campaign in June, but they are actually foreseeing that they will raise the interest rate as high as 5.6% before 2023 is over. And the reason why this was being raised is because the Fed members are actually projecting a stronger economic growth for the US. In March, if not mistaken, they're actually looking at around 0.4% growth, but now they're looking at around 1.0% growth. And also, US market, in terms of the employment market, in terms of labor market, is still very strong. US Fed officials are now actually projecting a more optimistic employment market. They are now seeing unemployment rate to close at 4.1% by year end, compared to their earlier projections of 4.5%. Next, as a result, market is now expecting 1 rate hike in the upcoming July's meeting on 26th of July. But we are in the camp that we think we are at the tail end of the interest rate hike cycle, and the pause will actually come soon. although we do not foresee the interest rate to go lower significantly, we think there's only one direction, which is going south. There are more rooms to cut the rate compared to hiking rates. Even if there's any more rate hike, we think at most perhaps 1 to 2 more times, right? And adding to this is our next slide. Looking at the valuation from the valuation perspective, we think in some US indexes, the likes of Nasdaq, the PE multiple is rather rich, currently at around 34 times. Of course, this will be due to the recent rising trend in the AI and tech names. But we have to draw your attention that some other regions, especially Asia and ASEAN, are actually offering pockets of investment opportunities given cheap valuations as well as promising outlook. The likes of China and Hong Kong, we see China is currently trading around 12.5 times PE. Hong Kong is currently trading around 9 over times. Some ASEAN countries and even Malaysia is currently trading at around 12.9 times PE. Should be our focus for this year. Next slide. If we were to zoom down to say S&P 500, the overall PE is currently standing at around 20 times. But from the chart, we can see that the forward PE for the big tech companies, namely Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta, is currently at 30 times, while the rest of the S&P 500 companies are trading much more lower than the 20 times level, around mid-teens, I think, which suggests that part of the S&P valuation is actually coming from the big tech groups. Next slide. Looking from the performance perspective, yes, year to date, S&P is up around 15.8%, close to 16%, but this is mainly driven by the 7 mega cap tech stocks that we mentioned earlier, thanks to excitement over AI. Without them, we see the performance of the S&P 500 could actually be quite underwhelming. We think the lack of the diversity in the S&P 500 could actually spell trouble for the future gains in the index, because if there's anything wrong with just one of the top stocks, perhaps it will actually knock out the entire index. Right? Looking at the next slide, we see according to IMF estimation, global growth will actually bottom out in 2023, growing by around 2.8%. Before rising moderately to 3% in 2024. And that will actually coming from emerging markets and developing economies rather than advanced economies. We see IMF is projecting emerging markets to grow around 3.9% in 2023, followed by a better growth in 2024, around 4.2%. And the next slide, we see actually the majority of the global growth is actually coming from Asia, and Asia is expected to contribute around 67% of the growth, mainly from China as well as India. And according to IMF forecast, Asia economic growth is poised to accelerate to around 4.6% this year, from 3.8% last year. Of course, this will be mainly led by India as well as a reopened China. And notably, China and India will actually grow by around 5.2% and 5.9% respectively, according to IMF estimation. Next slide. Of course, there have been a lot of noises on China's recovery. But one thing that we need to understand is that China has just fully reopened in January this year. And it's just maybe 5 to 6 months of reopening. We acknowledge that the manufacturing PMI numbers is in the third month of contraction, but it has actually slightly improved to 49 in June compared to 48.8 in May. And the non-manufacturing PMI numbers are still in the expansion territory. Of course, another thing that we have to note that China recovery so far has been services oriented. In 2022, if not mistaken, the agriculture sector has actually contributed around 7.3% to China's GDP growth, whereas close to 40% of the economic value added are actually coming from the industry, and close to 53% are coming from the services sector. Right. There will be pressure from for the government to actually booster monetary and fiscal policy support in order to show confidence among the investors. And we think this is actually also very important to drive the private consumption as well as the stability of the labor market. Right, next slide. Yes, we see some weaknesses in the property sector lately. Residential property sales started to decline in April and May. If you look at the second chart, average weekly residential floor space sales in the 30 major cities were running actually around 21% above the pre-pandemic level in 2019 in February, but subsequently dropped to 70% in April and May. Actually, we believe that such an outcome will actually raise the potential for more aggressive stimulus, especially in the property market in the coming months moving forward. Next slide. We see in terms of the domestic tourism, the recovery trend has been quite steady. And we also have to note that the recovery in the mainland China this year so far has been primarily a service sector affair in terms of the increased spending in restaurant as well as domestic travel. If you look at the latest holiday, Dragon Boat Festival actually delivered quite a resilient performance. In terms of the total revenue and the tourist number, it has actually recovered to around 95% and 113% of the pre-COVID level. And this is actually on par with what we have observed in the earlier Labor Day holiday. The numbers actually recovered to 101% and 119% respectively during the earlier Labor Day holiday. So we think the recovery trend is still ongoing. But if we were to look at the next slide, of course, the outbound travel will actually need to take some time. It remains quite weak actually because, of course, when we are traveling overseas, right, we need to get our visas done, passports. Of course, lack of flights could also be one of the major reasons compared to the pre-pandemic levels. If you look at the chart itself, China international airline capacity in May 2023 is just 42% of the pre-pandemic level in May 2019. However, we are seeing better momentum ahead amid continuous improvement for outbound travel. And most importantly, in the next slide, we see during the World Economic Forum, also known as Summer Davos, the session was held at Tianjin on 27 June. The key takeaways from Chinese Premier Li Qiang's speech is that China is actually expecting a stronger GDP in the second quarter compared to the first quarter. And this is mainly driven by the recent effects of the domestic consumption policies, particularly in the automotive and EV sectors, as well as infrastructure development initiatives by the Chinese government. And also another key takeaway that I would like to draw your attention is that China is actually on track to achieve whatever GDP target they have set earlier, which is 5% in 2023. We think China economic recovery will still be on track, and the government will continue to be committed to a more open market economy while boosting domestic demand for economic growth. Right. Moving on to ASEAN, next slide. We see ASEAN is actually a multi-year of structural investment story. There are 4 reasons why we like ASEAN. Firstly, given that international border reopening is ongoing, we think the travel momentum will continue, particularly in China, because China is actually easing their policies on cross-border travel. ASEAN demographic is favorable as we are seeing growing middle class, and that actually means rising disposable income. And we think companies with strong pricing powers will actually be resilient. We continue to see very strong end demand, and those companies are actually be in good positions moving forward. Of course, we know that USD strength and of course inflation have been quite volatile of late. But one thing that we need to note that both inflation as well as the USD have shown signs of peaking. And in fact, central banks in ASEAN, they have slowed down the pace of rate hike and even pause rate hike. Finally, China plus one, we believe that the ASEAN region will continue to benefit from shifting supply chains as well as diversification by MNCs. Because of trade war, ongoing tensions between US and China, we see MNCs, they are actually reducing their dependence on China and focus on building a China's plus one strategy. Of course, investors are very concerned on the foreign flows. Foreign flows to ASEAN are mostly negative year to date, with the exception of Indonesia, which saw some healthy foreign net inflows of around US dollar 1.09 billion year to date. But the rest of the countries like Vietnam, Philippines, Malaysia, as well as Thailand are seeing outflows. The reason is because negative interest carry. Investors are actually shifting their assets to the US markets because of the relatively higher interest rate. But we think the continuous decline in the dollar strength will eventually benefit emerging markets currency, the EM currencies, including ASEAN. And most importantly, looking from the valuation perspective, MSCI ASEAN is currently trading at around, I think, 13.7 times forward PE ratio, and this is well below the 10-year historical average of 16.7 times. All in, we believe ASEAN equities will continue to provide investors a combination of recovery plays, long-term structural themes, backed by positive long-term growth, strong fundamentals, and reasonable valuations. Next slide, we see tourism, right? How does tourism look like pre-pandemic? These are the numbers in 2019. But of course, if you continue to see more and more reopening recovery trend, especially in China, many ASEAN and Asian countries, including Malaysia as well, will eventually benefit from that trend. As you can see from the chart, right, ASEAN countries such as Cambodia, Vietnam, Thailand, Laos, Malaysia will be among the biggest beneficiaries as tourism activities regain momentum. Next slide. If we are looking from inflation perspective, if you were to compare the inflation levels in ASEAN versus the G3 countries, namely UK, US, so Germany, the inflation levels in ASEAN are relatively lower. And that's the reason why we don't see ASEAN central banks are raising rates as aggressive as their Western counterparts. Next slide. ASEAN is continuing to see, healthy trade flows as well as surplus. In terms of the exports and imports, recorded a sustained growth, if not mistaken, around 54% growth over the past decade, thanks to the trade flows within the ASEAN region, intra-ASEAN, US and China. And ASEAN trade surplus is actually underpinned by E&E parts that are mostly exported to China, EU and Japan. And also we see some healthy surplus coming from animal and vegetable products, which are mostly shipped to China, India, EU, as well as US. Moving to Malaysia, next slide. Of course, we know that investors are very concerned on the weak market and the weak currency. In the beginning of the presentation, I've pointed out that KLCI is now dropped by close to 8% year to date. But we have to understand that actually our fundamentals are still very strong, mainly because of our domestic consumption, stable labor market demand, healthy trade flows, and of course, sustained current account surplus. We see limited downside in the market because if you are looking from the foreign shareholding perspective, the June 2023 foreign shareholding is currently at 19.9%, which is close to historical low level. And hence, we think any potential further foreign selling will actually be capped. Fading political uncertainties. Yes, of course, we need to get more colors after the state election. The state election is now expected to be held in the month of August, and we expect a sustained market recovery in second half 2023, driven by relative political stability post-state election as well as improving domestic liquidity. But of course, we think the unity government led by Anwar is unlikely to implement any negative policy changes ahead of the state elections in order to gain the popularity. And finally, we think our monetary policies are still quite accommodative. The recent hike was in May. The OPR was increased by 25 basis points, and it's just back to the pre-pandemic level at 3%. Even if there's another 25 basis point of hike in the coming meetings, we think the monetary policies are still relatively accommodative compared to some of the regional peers. And even at 3.25% is also back to the pre-pandemic level. Next slide. Of course, we see ringgit has seen some weakness lately. We think this is mainly due to investors' concern on the high debt to GDP ratio. Of course, the lack of fiscal and structural reforms is the main reason of ringgit weakness. If significant fiscal reforms aren't implemented, we think the debt and we think ringgit will continue to see some weakness there. And of course, we noted that the foreign currency deficits are actually on a declining trend. Externally, ringgit continue to be influenced by global factors. For example, we see a stronger dollar, we see a widening negative carry. And in fact, from our research, US Malaysia negative 3-month interest rate carry has actually widened by 108 basis points to negative 1.80% lately. And that's the reason why we see a continued outflow and continued weakness in ringgit. And finally, weaker than expected China economic data. Among the regional currencies, actually, Malaysian ringgit has highest correlation with Chinese yuan. But if we are looking forward to China recovery in the second half, we think this will actually be benefiting Malaysian market as well as the local currency as well. Right, next slide. Ultimately, we think the country fundamentals remain very solid. We continue to record a positive current account surplus, as well as the net FDI inflows increased significantly in 2022 to around 73 billion, as we see MNCs, they are expanding capacity in our country. The beneficiaries of the increase in net FDI will be tech and E&E sectors. But of course, we will be able to see the real economic benefit to come through in 2023 as well as 2024, because it will take some time for the MNCs to set up plans, to commercialize their products, to hire people, to keep things going. So we'll only be seeing the recovery in tech and E&E sector going into second half of 2023 and 2024 onwards. And looking at the next slide, we see Malaysia continues to benefit from trade diversion. All right, thanks to trade war between US and China, as you can see from the picture there, you see lots of MNCs like Infineon, Intel, Broadcom. They are actually setting up plants in Malaysia because of our trade openness as well as low tax environment. And as I mentioned earlier, the sectors that benefited the most are actually tech and E&E in Malaysia. Also, according to Mina, if I'm not mistaken, Malaysia attracted approved investments of around 71.4 billion in the manufacturing, services and primary sectors for the first quarter of 2023. We will continue to see more and more FDI coming in Malaysia because of our low tax environment as well as trade openness. And this will continue to drive a sustainable economic growth of our country moving forward. And finally, our last slide. We think it's the right time to position in Malaysia market because the foreign shareholding is at historical low, as I mentioned earlier, is 19.9%, right? And hence, we see limited downside in the market because any potential further foreign selling will actually be capped. And looking from the valuation perspective, KLCI is currently trading around 12.9 times of forward PE, and this is actually significantly lower than the 10-year average PE of 17.5 times. We think our market could actually re-rate in second half, driven by improving domestic liquidity as well as relative political stability post the election, coupled with some earnings growth in the corporates. We think that will actually drive our market moving forward. Thank you, and we hope that our sharing will actually provide you valuable insights to you. And thank you for your attention. Thank you.
Okay, with that, thank you for our friendly speaker from Phillip Nature, Kim Cho, who has presented on the macro side of the view. And with me, I'll take over to talk about the stock picks for second half of 2023. And then first of all, I'll have to address this, which is, hold on. Something is blocking my view. Okay. First of all, I need to go through this disclaimer, which basically means that although reasonable care has been taken in while preparing for this presentation, no responsibility or liability is accepted for any opinion expressed during this presentation. And with all that, we are good to go. So we'll start off with my stock picks with Gamuda. So basically, Gamuda's core business revolves around both engineering, construction, and also property development. And for its engineering and construction division, Gamuda has infrastructure projects across Malaysia, Australia, Singapore, and also Taiwan, with its core capabilities in tunneling and track infrastructure. And then as at 30th April, the unbilled order book for Gamuda is at outstanding of 21.5 billion, which essentially will provide clear revenue visibility for the group in the next 4 years. And then moving on, we'll look at its property development division. And similarly, Gamuda also has its property development presence well spread across Malaysia, Vietnam, Singapore, and also Australia as well. And its property unbilled sales stood at 5.7 billion, which would essentially provide revenue visibility for the next 3 years. And then moving on, let's take a look at its earnings trend. So its revenue recovered significantly in financial 2022 and achieved an all-time high revenue of 4.9 billion, which is mainly attributed to the increased revenue from its property division, where it achieved more than 4 billion pre-sales. And then moving forward, we're expecting the margins to normalize within the similar level of 2022 for the near term, mainly due to the increased contributions of its Australia construction business, which typically has a slightly lower margins as compared to its local tunneling contracts, where it used to do projects for MRT or this, but then since MRT2 came to an end, and with the Australia construction business taking a bigger portion in its revenue contribution, we expect the margins to trend slightly lower. And also at the same time, building materials price still remain elevated as a result of higher commercial electricity rate in Malaysia. But nevertheless, we still foresee Gamuda to continue its growth momentum in the next few years, mainly driven by the growth initiative that it's been taking to grow its core businesses, which I'll talk about in the next few slides. So first of all, one of the most exciting story for Gamuda would be the acquisition of an additional construction arm in Australia. And with this acquisition of another Australian construction company that can basically replicate Gamuda's capabilities in Malaysia to Australia as well. And the deal is actually already completed, and more than 4.5 billion of the order book has already been transferred to Gamuda's order book, while the remaining 1.5 billion ringgit order book will be gradually transferred to Gamuda's order book by this month. And then the synergy that I can get from this acquisition would be key opportunities to undertake mega projects in Australia from its some of the rail loop planning such as Sydney Metro West and also suburban rail loop that could translate to more than 30 billion new wins for Gamuda in the next 2 financial years. And then moving from that, another key growth strategy for Gamuda for its property development would be building up quick turnaround projects portfolio, which essentially means that quick turnaround projects are projects that require less capital outlay. At the same time, it would complement its core townships. And over the next 2 years, it aims to have a portfolio of 10 quick turnaround projects, which is expected to deliver 2 billion in pre-sales by next financial year. And also, another growth strategy for Gamuda would be aiming to diversify into renewable energy segment, but which I expect more investment or acquisition will be announced in the coming months. And with all that, we have a buy rating on Gamuda with a target price of 6.01, while the closing price of Gamuda as at last Friday is at 4.38. And then moving on, we have another construction company that I'm going to do a basic overview on, which is Kerjaya Prospect, which is basically quite well known in the industry as an expert in high-rise construction. And what does it mean to be an expert in high-rise construction? The answer of it can actually be found in its order book composition. So currently, Kerjaya Prospect has an outstanding order book of 4.7 billion, providing revenue visibility for the next 3 years. While most of all these contracts are actually high-rise construction contracts for well-known developers such as Bukit Bintang City Centre Development, Gamuda, UAM Sunrise, and also Eastern Oriental. And its achievement in securing such strong clients in its construction order books speaks volume of Kerjaya's ability in delivering high-quality, high-rise construction. And moving forward, although the core business of Kerjaya Prospect is in construction, they actually have a smaller business, which is property development, that is aiming to launch 2 property developments in the coming year. And this would essentially bring in a total of 630 million GDV, which should complement its revenue growth in the next 3 years. And these 2 property developments are the View at Monteras, which would be launched in the second half of this year, and also Papyrus at North Kiara, which would be launched in next year. However, Kerjaya Prospect is unlikely to undertake more land banking activity to continue this property development segment. So these 2 is likely to be the last 2 projects for Kerjaya Prospect to undertake, because they're planning for the property development side, they will try to move it more to another listed company, which is Kerjaya Prospect Property, and also another related parties company, which is E&O. So Kerjaya Prospect will remain as they will try to keep the core focus of Kerjaya Prospect at construction. And then now we'll take a look at the earnings trend of Kerjaya Prospect. So we can see that Kerjaya has been able to maintain its PAT margin at a range of around 10%, which is one of the highest among the construction industry, which typically range around 8 to 10%. And with Kerjaya Prospect being able to secure, consistently deliver around 10% PAT margin, it puts them as one of the highest, higher than average PAT margin among its peers. And then the growth story for the Kerjaya still mainly revolves around its core business of lie in its ability to secure strong clients, and also a strategic focus in the tendering stage, where they'll try to focus more on high contract value projects, which are then usually more than 300 million, where they find it less competitive, and also they have the stronger strength in. And with all that, we have a buy rating on Kerjaya with a 1.48 target price, and the last closing price as at last Friday is at 1.1. And then now I'll try to gradually move on to the property sector from the construction sector. And as we move into the property sector, we should first take a glance at some of the Malaysia property market statistics first. We can see that residential property transaction recorded a 22.3% year-on-year increase in 2022, recording a higher sales volume than pre-pandemic years of 2018 and also 2019. And from that, properties within the affordable price range, which is in this case is below 300, which is in this case is 300K and below, contributed 56% of the volume, which essentially means that it is one of the main driver for the property market in 2022. While the next company that I'm going to introduce is a developer that fully focuses on developments within this price range of 300K and below. And it is Lagenda Properties Bhd, who is a pure play affordable housing developer. And Legenda's business model is basically mainly driven by its economies of scale and also operational efficiency, where it launches townships with mass volume, which townships with more than 1,000 units, where they get to find the economies of scale and also operation efficiency, where they employ same housing design across all its townships, where it managed to save a lot of costs in terms of design, approval, and all this kind of planning. And one key recipe to its business model is also the efficient land planning, where it tries to ensure quick turnaround of all its land bank so that it doesn't hold a huge amount of land banking that would essentially eats up a lot of finance costs. And with that, Lagenda is able to sell its property at a very competitive price, as shown in the graph, that is essentially represent how they penetrate the housing market in Perak. So in for the housing market in Perak, the average selling price is around 194,000, but Legenda's township in Perak is actually selling at 135 to 250K, which is just roughly in between the maximum affordability of the M40 and B40 household income. That essentially drives the consistently high take-up rate for its development across townships, with an average take-up rate of 82% across all its townships, and also unbilled sales to the 781 million, which we expect roughly half of it will be realized in financial year 2023. And let's take a look at the earnings trend of Lagenda as well. So you can see that even though during the pandemic years, they managed to maintain their revenue growth, and that basically just tells a picture that the property that Lagenda are offering is actually necessities for the lower income group, which drives revenue growth for the group even during pandemic years. And moving forward, we expect a substantial revenue growth, but margins to gradually trend lower as it plans to expand into other states, which I will share in the next slides. So moving forward, so for its multi-states expansion plan, Lagenda initially was mainly focused in Perak, where in 2020 onwards, it started to venture into other states such as Kedah and also Johor. And as they venture into all these states, they have to go into some joint venture model with some of the landowners in these states to leverage on their regulatory position and also leverage on their reputation within all these locations. But for them to go into all this joint venture model with all these landowners, it will essentially means that lower margins for the group, because they have to share some of their profit with all these landowners. But as they build up reputation in all these other states already, they will start to acquire more land and develop it by itself, so that they can recover back to the margins that they used to have. And with all that, we have a buy rating on Lagenda as well, with a target price of 1.54, and also the closing price as of last Friday is at 1.2. And now, the last stock coverage that I have right now would be Skyver Development, and I'm trying to be mindful of the time so that I can have more time allocated for Q&A. So Skyver is a developer that focuses on high-rise development in Klang Valley. And similarly, let's take a look at the property market statistics of KL first before we look at Skyver. As you can see, from the residential property transaction in KL by price range and types of buildings, you can actually see that property between the price range of 300 to 500K and also 500 to 1 million have the highest compounded annual growth rate in the past few years, which are at 6.4% and 5.6%. While also based on the type of building, high-rise has the highest compounded annual growth rate in KL, which basically means that there's a growing demand for high-rise property within the price range of 300 to 1 million. And this is exactly what Skyver has been developing. And with that, that essentially translated to a high average take-up rate for most of its property development, as well as an average take-up rate across its property developments of 85%. And the current unbilled sales stood at 968 million for Skyver. And in terms of the earnings trend, the group consistently achieves around 15% of PAT margin, which is considered higher than average for some property developers in Klang Valley. And this is mainly driven by its fast turnaround of projects, where it tries to aggressively launch all these projects as soon as they get it into their land bank. And for the growth strategies of Skyver, it mainly revolve around growing its existing strength in Klang Valley, and also they are planning to venture into Vietnam property market, which is Ho Chi Minh, as they are actively looking for land deals over there. And more announcement for this site would come in the coming months. And then on the other hand, they are also developing 2 build-to-rent investment properties to generate recurring income, which we expect it should commence by next year. And before that, we have an outperform rating on Skyver, which the target price is at 90 cents, while the IPO price of today is at 80 cents. And yep, with all that, I think that's the stock picks that I have.